Hello, everyone. Welcome to Economic Narratives. Thanks for joining me. Today, we need to talk about something that's already reshaping the global economy, even if most people haven't fully realized it yet. Right now, two things are happening at the same time. Germany, Europe's industrial powerhouse, is losing momentum, and China is trying to export its way out of a domestic economic slowdown. These aren't separate stories. They're tightly connected, and together, they point to a major shift in global manufacturing power, one with serious consequences for Europe, for China, and for the global economy. Let's start with China. In 2025, China's trade surplus exceeded $1 trillion. That means China exported $1 trillion more in goods than it imported. That's not normal for a mature economy, and it's not a sign of strength. It's a sign that China is leaning heavily on exports because domestic demand isn't doing the job. Official data shows that net exports accounted for nearly 30% of China's GDP growth last year. Some independent estimates suggest the real figure may be closer to half of total growth. Think about that for a moment. China has spent years saying it wants to rebalance toward domestic consumption, yet it's becoming more export-dependent, not less. So why is this happening? Because China is stuck in a deflationary slowdown. Home prices have been falling for more than 4 years. Household wealth has taken a major hit. Consumer confidence is weak. Investment growth has slowed sharply. Producer prices, the prices factories charge, have been in deflation for over 3 years. And inflation for consumers is barely above zero. When factories keep producing but people stop spending, excess supply builds up. That excess has to go somewhere. So it gets exported. Beijing had options. It could have supported households more directly. It could have boosted consumption meaningfully. It could have reduced the economy's reliance on exports and heavy investment. Instead, policy support for consumers has been limited. Even recent programs aimed at boosting spending are small relative to the size of the economy, and similar efforts in the past have had little impact. So instead of rebalancing, China has doubled down on what it already does well. China has poured massive investment into electric vehicles, batteries, renewable energy equipment, advanced manufacturing. This has improved technological capabilities, but it's also created overcapacity. Chinese factories are producing far more than Chinese consumers can absorb. With domestic demand weak, exports become the release valve. And increasingly, those exports are being routed through emerging markets, especially Southeast Asia, as companies adjust supply chains and avoid trade barriers. The result is a surge of low-priced manufactured goods entering global markets. This isn't just about competition. When a country experiencing deflation exports aggressively, it also exports price pressure. Firms sell at very thin margins, sometimes just to keep factories running. That creates serious problems for manufacturers elsewhere. And nowhere is this more visible than in Germany. Germany has now experienced 2 consecutive years of economic contraction. That makes it the only major advanced economy to shrink while others continue to grow. This isn't a short-term dip. It's structural, and there are 2 main reasons. First, energy. Germany's industrial model was built on reliable, affordable energy. That advantage disappeared after the loss of Russian gas. Even today, energy prices in Germany remain far higher than in competitors like the United States. For energy-intensive industries, chemicals, metals, heavy manufacturing, that's a massive disadvantage. Second, exports. For decades, Germany sold high-value manufactured goods to China. That relationship has changed. China now produces many of those goods itself, often cheaper and increasingly competitive in quality. In sectors like electric vehicles and industrial machinery, Chinese firms are no longer customers. They're competitors. German manufacturers are now under pressure from both sides. Costs are higher at home. Prices are lower abroad. The result? Falling industrial output, slower investment, rising unemployment, companies shifting production elsewhere. Some of Germany's biggest firms are investing abroad instead of at home. That's not just a business decision, it's a warning sign. This isn't just about Germany. Across the euro area, growth is weak. Southern Europe is supported largely by tourism, not industrial strength. Without a strong Germany, Europe lacks a clear economic engine. Fiscal policy can help, but it can't easily fix energy costs, demographics, or global overcapacity. So here's the bigger picture. China's weak domestic demand pushes exports outward. Those exports intensify competition globally. Germany, already weakened by energy costs, feels the impact most. As German industry slows, Europe slows with it. And because China's domestic situation hasn't improved, this dynamic isn't going away anytime soon. There are no easy solutions. China can't quickly rebalance its economy. Germany can't rapidly restore cheap energy. Europe lacks the political and fiscal capacity for a coordinated response on a necessary scale. What we're seeing is a gradual shift in global manufacturing power. Not a collapse, but a realignment. Europe isn't disappearing. Germany isn't finished. But the old model is clearly under strain. The world is moving toward a new equilibrium, one where manufacturing is more concentrated in Asia and competition is far more intense. The question now is whether Europe can adapt fast enough, or whether slower growth becomes the new normal. I'd love to hear your thoughts. Can Germany regain competitiveness? Can Europe keep up with China's manufacturing scale? Or are we entering a new era of industrial decline in the West? Let me know in the comments. If you found this analysis useful, consider subscribing. It really helps the channel. Thanks for watching, and I'll see you in the next video.